Hi guys, this is Robert Rivera with the Rivera Trading Group in association with Trend Trading Academy. And today I want to talk to you about leveraging. Leveraging is necessary in Forex because none of us have enough money. Well, some of the big boys do, but none of us have enough money to be able to trade in Forex the millions of, the hundreds of thousands of dollars perhaps that it takes, the thousands of dollars for sure, that it takes to move a pip, okay? Not to move a pip, but to gain a pip or pipette. Let's say. If you don't know those terms, look them up, Google it. You'll find the information pretty easy. But bottom line is, because it takes so much money to be able to get in the market, we have to use leverage. Now, it's always been a question as to what leverage is good, or is it too much? Is 5 to 1 good leverage, 10 to 1, 50 to 1? You know, most U.S. brokers have a 50 to 1. I think all of them. And then overseas, they can give you as much as 1,000 to 1. I mean, which is kind of crazy. The broker that I use, LQDFX, uses 300 to 1 during the live account and 200 to 1 on the demo account. And I think it's pretty appropriate. You don't need much more than that to trade well in Forex. You're not really going to use that much. But here's my point about leveraging. There's two ways of using leveraging. One is not using enough, and another one is using too much. This goes to risk management. For example, good risk management will mean that if you are an excellent trader and you trade 3% of your account, then you have about a 30 pip drawdown that you can manage without hurting your account, right? Without hurting your account. Without doing it to a level that is going to be damaging your account too much. So that means that at 2%, you can use 60 pip drawdown as a margin. And on a 1%, you can do 90 pip drawdown. So what does that mean? Since we know that the market fluctuates up and down, if you use leverage that you can actually manage, like a 1%, for example, you can let it do what it's going to do. It can go against you significant amount of pips, and you don't freak out because it's not going to hurt your account. Obviously, we use price action, so we're not going to let it go even 30 pips against us if price action is telling us that it's time to get out, to be honest. But if the market structure and price action, it's telling us that your trade is still valid, then the lower lot size, which is using less leverage, will allow you to withstand the swings of the market. You know, last night I sent out 2 trade setups, GBP USD and GBP AUD, and I remember some of the people on the team, unfortunately, were freaking out because the market was going up and down, up and down, up and down in the zone. But when you look at the market structure and the overall trade, you find that if you entered in the sell zone, then you were somewhere between 3 pips and 9 pips in drawdown at any given time. 3 pips to 9 pips in drawdown is nothing, really, in Forex, especially with a GBP pair. It is nothing. So why would anybody be upset or freaking out because it's going against them 3 to 9 pips? They're freaking out because they're over leveraged. Basically, they put too much money at risk, and now they cannot withstand the uncertainty of which way it is going to go. If you have proper lot size, like let's say again 1% or even less, and that thing is whipsawing 3 and 9 pips, 3 and 9 pips, 3 and 9 pips, it's no big deal. The market structure is still holding. And then finally, when it made its move, it dropped 100 pips. It dropped 100 pips from the sell zone, which is what we were looking at now. I mean, it gave us a signal for a sell, and so we entered a sell. Now, once we entered a sell, it kind of stalled there for a while. It stalled for a while, but it still dropped for 100 pips. And GBP AUD gave us about 9 pip drawdown before it finally did what it told us it was going to do. Again, based on price action and market structure. And really, nobody's account was under threat last night if you were using proper risk management. Now, if you have over leveraged your position, you cannot withstand it even going 9-10 pips. You can't. because it's just way too much to your account size. So again, if you're using too little leverage, then you're not seeing significant profits. Of course, you're also not losing much if you're losing. If you're using too much leverage, which is the real danger, then you cannot withstand the normal move of the market. The market moves in waves, right? It moves up, it moves down, it moves up, it moves down. And but once a significant zone is broken, that's the direction. That's the direction that we're going, especially after a retest, right? I mean, if you don't know how to do the breakout and the retest, we can teach you how at Trend Trading Academy. We're very happy to. It is a very simple strategy, and we do amazing with it. Again, we're making about 50 pips per trade on them. I mean, that's what the setups give, and about 500 to 800 a week. Okay, you could take advantage of those and do well with those if you're not over leveraging. If you're over leveraging, then you cannot withstand when it's starting to move against you. Okay, so anyway, I could talk a lot. There's a lot to be said about leveraging, but let's keep it short. All right, it is a Friday. The market's about to close, and we're going to enjoy our profits and our families this weekend and be ready for Sunday evening when London opens. Okay, this is Robert Rivera with Rivera Trading Group, again in association with Trend Trading Academy. God bless you all.